Thank you, operator. Limeade CEO Henry Albrecht here, presenting our financial results for the full year ended 31 December 2022, known as FY22. Joining me today is Limeade President and COO Dave Smith and Limeade VP of Finance and Controller Paul Crick. That's on slide 1. On slide 2, you can see some important notice and disclaimer. Certain statements in this document and this presentation constitute forward-looking statements. On to slide 3. Limeade is an immersive employee well-being company that creates healthy employee experiences. Today, millions of users in 100+ countries use Limeade solutions to reduce burnout and turnover and increase well-being and engagement. Limeade employs hundreds of purpose-driven people in North America, the European Union, and the Asia-Pacific region. Limeade is a software as a service, or SaaS, business with 96% recurring revenue in FY22. Limeade Wellbeing is our flagship solution, primarily targeting enterprises with over 5,000 employees to infuse care into work and drive essential employee experiences and benefits resources to those who need them most. In FY22, this solution represented 88% of our total contracted annual recurring revenue, or CAR, as at 31 December 2022. Limeade Listening, the other 12% of our CAR, incorporates the TinyPulse technology acquired in July 2021, primarily targeting the mid-market, and provides listening, recognition, and management tools that build real employee engagement. Operator, moving on to slide 4, please. I'm sorry. Our market opportunity, yes, that's 4. The global corporate wellness market is worth $73 billion and is forecast to show annual growth of 6.8%. All dollar amounts in this presentation will be in US dollars. Stress, burnout, and US healthcare spend are all trends headed in the wrong direction. Mental health, social isolation, addiction, remote work, financial fears add to the employee stress mix. And in a recession, the market demands a hard return on investment, or ROI. In August 2022, Limeade commissioned the Total Economic Impact Study conducted by Forrester Consulting. The key outcomes they published were that organizations using Limeade showed a return on investment of 119% and a payback on their investment of less than 6 months, with over $5 million in present value benefits. Turning to slide 5. In FY22, we spent considerable time and effort investing in our Limeade Wellbeing content experiences, integration capabilities, personalization, and our unique strength in employee communications, all based on what we call Limeade One technology. These investments created competitive wins for the business in FY22 and set the stage for improved scalability and gross margins in FY23. Slide 6. Hold on. I got this. Turning now to slide 6, thank you. During FY22, we accelerated our Microsoft Teams and Viva integration efforts and our Limeade Plus partner innovations. These efforts have driven record year-to-date FY23 requests for proposals, or RFPs. In addition, we've seen now over 1,400, not 1,200, 1,400 signups for the virtual Lime conference that we held earlier today that featured keynote presentations and panels, deep dive customer sessions for listening and well-being, and a co-presentation with Microsoft about our Limeade plus Microsoft Teams integrated experience. LimeTime is a quarterly event series designed for attendees to learn, connect, and be inspired by industry experts, world-class content, and fellow HR and benefits leaders. Dave, I think I'll pause now, and you and I can chat a bit, but just maybe a little more detail on some of the investments and how you expect them to pay off for Limeade in FY23.
Yeah, sure. Happy to, Henry. Thank you. So in addition to the investments that you described, there's a host of things that we're doing in product development and customer success, and these are aimed squarely at customer retention and cost reduction. I'll just touch on a few highlights. One is, in addition to the content, personalization, and teams, we're upgrading Limeade One messaging and notification to increase registration and participation, and ultimately monthly active users, which is the key metric for our customers. And then we're also continuing to deliver on accessibility, data governance, and security certification capabilities that we promised our certain customers we would execute on. Within cost reduction, in customer success, we've actually combined both of our two customer success teams into one, which we think will deliver cost savings and also speed our response time for customers. And then within product development, we're looking at our annual reset process to make this easier and less labor intensive for us, and also give customers support for multiple program years. And then finally, we're looking at specific platform upgrades and working with our cloud service providers to make changes that will reduce our overall cloud costs. Some of those projects are underway right now, and we'll be able to share more during the year. And that was it for me, Henry.
Okay, thank you, Dave. Sorry, I briefly got cut off and I'm back in here, but thank you for that color commentary. And that's perfect timing to hand it over to Paul. Paul, I'm going to introduce our Limeade VP of Finance to walk you through the FY22 results in more details. Paul?
Thank you, Henry.
Come off mute.
On slide 7.
Okay, great.
On slide 7, our revenue of $56 million was up 1% on the prior corresponding period, or PCP, with gross margins down 4% to 69%. The company recorded an adjusted EBITDA loss of $7.7 million, down $2.2 million on FY 2021. Adjusted EBITDA excludes one-time expenses and non-cash stock compensation expense. CAR was up 5% to $59.5 million. Net revenue retention, or NRR, was 86%, up 7% from 2021. We closed the fiscal year with $2.6 million in cash. In early August 2022, the company extended and amended an existing line of credit agreement with Comerica Bank. Also in the year, we added 13 new well-being customers and 174 listening customers for the year, providing a total new customer count of 1,060. Average well-being CAR per customer was $524,000, and the average listening CAR was $10,000. Turning now to slide 8 for our statutory income statement. The 1% revenue increase was predicted by our FY21 year-end CAR, though it was partially offset by $1 million in lower revenue from third-party biometric events and coaching services. The decrease in gross margin was driven by headcount increases and higher hosting costs. As Henry will mention shortly, we predict improvements in our overall gross margins in FY23. Looking at our major OpEx line items, the decrease in sales and marketing was primarily driven by decreases in headcount and the increase in research and development expenditure, primarily related to headcount to support investments in our product and technology, which drive scale and value in FY23 and beyond. Increases in general and administrative were largely driven by increased legal and accounting fees incurred to support SEC registration activities. These expenses represent $1.1 million of the one-time expense adjustment from EBITDA to adjusted EBITDA in FY22. Turning to slide 9, which recaps the FY22 results in the context of the guidance we issued during the year. In short, we're very pleased to have met our guidance ranges for revenue, adjusted EBITDA, and net loss after tax. We focused on retaining customers, attracting new customers, investing into our core well-being and listening platforms, and materially strengthening our leadership team. During the year, we successfully registered Limeade with the U.S. Securities and Exchange Commission. This registration was associated with significant upfront cost. U.S. resident investors of all descriptions can now purchase Limeade securities on the ASX. The for U.S. designation on the company's CHESS Depository Interests, or CDIs, on the ASX has been removed. And now back to Henry for the Limeade FY23 outlook.
Thank you, Paul. Just one clarification on the prior section. Although we would have loved to have 1,060 new customers, the word new was incorrectly inserted, but we have 1,060 total customers. And moving on to slide 10, FY23 guidance. We are forecasting revenues in the range of $57 to $59 million, driven by strong Q4 FY22 new sales growth in well-being, coupled with investments in innovation and customer service for our large well-being customers. We forecast positive adjusted EBITDA on a full year basis, with our guidance set at 0.5 to 2.5 million. Note that this is an $8.2 to $10.2 million forecasted improvement over FY22. The primary improvement driver was the strategic restructuring plan announced in January FY23 that decreases OPEX by $7 million annually. The company has implemented additional cost-saving measures and is committed to careful cost management towards its adjusted EBITDA target. The net loss after tax of 5 to 7 million reflects those operating efficiencies and decreased expenditures that I mentioned. In addition, we do anticipate our gross margins to improve in FY23 to a more historical level of the low to mid 70s% range. Finally, to cash. As we have shared in public prior investment communications, we anticipate that the business will be cash flow positive in the second half of FY23. Moving on to slide 11. Thank you. I will now hand over to the operator for the question and answer session for myself, Dave Smith, and Paul Crick. Thank you.
Thank you. If you wish to ask a question, please press *1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press *2. If you're on a speakerphone, please pick up the handset to ask your question. Your first question comes from Jules Cooper with Shaw and Partners. Please go ahead.
Hi, Henry. Thanks for taking the question. I just wanted to touch on the FY23 guidance. It's at the high end lower than your FY22 ending CAR, and I guess I just want to understand there, is that due to the phasing of some of your fourth quarter sales and when they ramp up, or are you sort of, indicating there and putting a buffer in there for, maybe more elevated churn that means we just don't see that CAR number translate through into revenue in the year ahead?
Jules, excellent to speak with you. Great question. I would say that the first thing is we did sign a disproportionately large percentage of our deals, even by historical standards, in Q4 and in some cases late in Q4, and they were quite large deals. And so sometimes those large deals do have an additional lag between when we sign the deal, say in December, and when they launch, and that could be a few months, it could be several months. So I think that's probably the primary cause, and I think the second is just general uncertainty about the economic, macroeconomy. But I think it's primarily the lag factor.
Okay, all right. No, that's good.
And Paul and Dave, if there's anything you wanted to add to that, please do. Thanks, Jules.
Yeah, and maybe one more follow-up. Just, great to see that adjusted EBITDA positive guidance. But if we think about, your capitalized development costs through the cash flow statement, how should we sort of think about that, contribution in FY23, maybe relative to 22, or just some sort of ballpark figure so we can sort of get a cash view of that adjusted EBITDA?
Yeah, I think we view it as general, and Paul, I'll call on you in a minute to provide any additional detail, but the general response is we view that as generally probably relatively stable year over year from FY22 to 23. I don't think we see a huge deviation one way or the other in the percentage of capitalized software expense. But Paul, would you add any color or commentary to that?
Yeah, one comment would be that we did have some pretty large investments in R&D, and that was reflected in the capitalized software expenses in FY22 and maybe the last half of FY21. I would expect that in FY23 those costs are probably down to flat, so they should not be increasing year over year, 23 over 22.
Got it. And then, so therefore, what you're sort of communicating is, you know, a positive working capital contribution in the year to sort of achieve your cash positive in the second half. That's how we interpret that, yes?
Yeah.
Got it. All right. Excellent. Thank you very much. Well done.
Thank you. Appreciate the questions.
Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. We'll just pause momentarily for any more questions to enter the queue. There are no further questions at this time. I'll now hand it back for closing remarks.
Thank you, operator. Thank you all. We look forward to updating investors on our progress for the remainder of the financial year. We also look forward to reporting our next quarterly results and seeing our Australian investors at our annual general meeting in mid-June. Onward. Thank you.